Rico's.
Meet through Monday. Great music through the punchlines. Like, tapi apa means 30 years. Can you do? Yeah, nice. My wife said, yeah. Then I know. That's good. True. Good. To watch. Yeah, it's good.
Good morning, everybody. Welcome to the Silver Panel, day 2 of the SMI. I had the pleasure last March of sitting where you are and watching the wonderful Claude Bouget host the Gold Panel, which was very insightful. So I'm sure this will be equally as insightful with our panelists today. So let's start with some introductions if we can. Peter, first of all, just tell us a little bit about your book and why you like silver so much.
I don't know if we have enough time for that. So I published The Great Silver Bull 3 years ago. And so we were just chatting about that. Obviously, some things need to be updated. Sure. But I'm happy to say a lot of what I hoped or expected would happen has come to pass. Mm-hmm. And so that's that's kind of I think a bit of a reference guide in terms of macro and silver specifically and how to invest in silver. Mm-hmm. And I write actually now 2 investment newsletters. One is paid subscription Silver Stock Investor, and then there's a sponsorship-based newsletter called Silver Advisor, and keeping me very busy.
Well, I was talking to you yesterday, and you said that subscriptions have skyrocketed recently, so that's clearly
the past year and a half. Yeah, absolutely. Along with the price of silver.
Well, yeah, I'm sure that helps.
Yeah, certainly has.
Exactly. Eric from AUAG Funds, just give us a brief introduction to yourself and the fund, please.
Well, we are fund managers, and we have like 560 million investor AUM in 6 years.
Mm-hmm.
And our flagship fund is the Silver Bullet Fund.
Mm-hmm.
So
and that's this fund here, yeah?
Yeah, we like all metals, and we like gold, we like copper, but we really love silver. So yeah, this is a fund, and we can maybe talk about that.
Yeah, indeed. Yeah. But quickly on that, that's outperformed, I think, hasn't it? The spot of silver?
Well, first on the right top we have against the CLE big ETF, so I mean outperforming with 100% still second. And now we have this year, when I think it's very interesting to see the outperformance vs silver. So anyway, the equity is doing much better than in the commodity so this year, so it's very
good. Okay. What's up?
Well, we're secular thematic investors. I've been a general asset allocation multi-asset investor for almost 30 years. And 2 years ago, we launched our own firm where we have an ETF listed in the US. And it's a secular theme. And we believe the next big secular cycle is a commodity super cycle. And silver is a big part of it, but also there's gold, there's oil, there's gas, and there's copper, there's platinum. So we own a variety of different exposures through equities. So we're primarily equity investors. And I like to say I'm not a tourist. I am an expat, so I'm going to be here for many, many years because this is a multi-year secular cycle.
I love this secular, the way you move, you say you're an expat, and I think people will be very happy to hear that you think it's a super cycle in commodities.
Yeah, that's
your return to tangibles, which we'll talk about. Yeah, it's fascinating, so we'll get onto that in a moment. Sen from Baker Steel.
Yes, thank you very much for the introduction. We're a specialist in quantity equity investing based in London. We run about $2 billion US, but we've been in the business longer than you, for 20 years, so I have more time. We run 3 strategies: precious metals, equities, then a specialty metals equities fund, both UCITS and very liquid, and also closed-end fund. I'm glad to say we outperformed both indices and most peers this year. The asset class has performed generally, but we made about 140-something% in the precious metals fund. I'm glad to say we're overweight silver producers, and therefore excited to be come and talk about this risk.
Thanks. Good stuff. Well, I want to just come back to something that was said in March by Florian Grimmers, who was on the panel yesterday morning. He's a technical analyst, and he said, watch for silver showing up before the gold starts to cool off. So I want to get a sense of what's happened because, of course, gold has done extremely well since March, and silver has started its move. So are we now, is that a warning sign? Is the gold run coming to an end, or are we really in the early days? I want to ask you first, Peter, on that.
So my sense is that no, it is still very early days in this bull. I think that we're just sort of starting, I think, to get the edge of the retail investor, the generalist, starting to come into this and paying attention and really kind of taking advantage of it. But I think it remains early days. Yes, silver has run with gold and has surpassed it if you look over the past year and a half. And but I think what Florian was referring to is the kind of behavior you have in silver towards the end of the cycle, and I really don't believe we're there at all.
No, we're not even close. Eric, do you have any thoughts on that?
Well, first of all, I think we are at 4,000, we were at 1,400, and 5,000 is not far away. We've seen the big banks even say 5,000, 6,000. And I think yesterday said 2030 we're up somewhere at 8,000 or 9,000 or much more. I think that if we have 10,000, we can go making 2.5x on that from today. I think silver will make 6x,
Right.
but actually I think the miners will do 15x.
Yeah, okay. Good stuff. Sven, your thoughts?
Yeah, I mean, I think there is an important aspect to keep in mind with regards to both gold and silver prices, and that is they're obviously not perfectly correlated, not even with lags. And that it's because, 55% of silver production is used in industry, as most of you know, photovoltaics, 5G, defense industry, medical equipment, etc. So I think, one has to look at fundamental factors like, multi-year deficits of silver, which is, driving the price to some extent. But also I would acknowledge that on the financial side, some investors, use silver in the same way, hedging against risk. And we have some central banks investing in silver, even though obviously storage-wise it's a little bit more complicated. So I would say that yes, on the one hand there's a liquidity aspect in terms of money coming into the silver market from financial investors, but there is obviously the industrial side, and both forces, contribute to price development in the silver market.
How much would still be, do you think, compared to gold in terms of inflation hedge? Because of course gold is traditionally looked at very much an inflation hedge.
Yeah, I mean, I'd say it's, in terms of value drivers, probably about half in terms of what the silver price does. But in terms of, if you ask me, professional investors, do they consider silver as an inflation hedge? I think that's still a minority, so it's primarily still gold, which is a safe haven. But, I think why a lot of people get excited about silver is also because of higher volatility, meaning positive volatility in a lot of cases right now. And obviously the catch-up trade, if you look at just chart technicals and the silver ratio, we're at 80, we should be really, the median is roughly 50. And if you look, for example, at the highs in the 80s of the silver price, if you look at this inflation adjusted, we should be at 200 right now, but we're at 50 something right. Okay. So I think from that point of view, there's lots of potential. I would also say that, generally there are potential negative factors. There's thrifting in the solar industry. The Fed may come to the wrong conclusion in terms of the economy, certainly for the silver market. So there are also threats of the silver market. It's not a one-way direction, and there will be volatility, I understand.
Okay, good. Peter, I think this is your chart, but if you could just explain what this is. It's obviously a nice big silver bowl you've got on top there as well.
Great. So it's very simple. What I did was I looked back at what I gauged as major silver bull markets since 1970, 71. And they've done well. They've averaged 500%, a little over 500%, and they've lasted about 3 years, just over 3 years.
Okay.
And I have on the last here at the end, I have the last bar, which is the current one, which I gauged started in around September 22, and that brings us up to almost 200%, or at least at the peak this past October, so about a month ago. We were up about 200%, and it had lasted just over 3 years. So gives you some idea. I think if you just look historically what average bull runs were like in silver, that this one hasn't peaked yet. You can never know for sure, but it just speaks to, I think, to the potential. That's one of the reasons I was saying earlier. I think that we're still very early, and honestly, I think this will come in waves. I don't think that I think this particular run is not over, and I don't think that when it is over, it'll be the end either. I think we'll have these big waves, and potentially this could last another 5, 6, 7 years, maybe even longer before we reach an ultimate peak.
Really? Okay. And do you think we'll see a bar similar to that 1976, 19?
I do.
Yeah.
I think it'll possibly surpass it. Oh, I think so.
Okay. Well, you heard it here first. At the SMI. Thank you, Peter. Wasis, I want to get your thoughts on where we are and your return to tangible theory.
Sure.
Looking at the chart, which is fascinating, I would like to explain it to us. I guess you think we're just almost at the start.
Yeah, it's early innings. I would echo what Peter said and others have said as well, that we're in the early innings of this commodity supercycle. So we, being multi-asset investors, we look at the world from a macro standpoint, and then determine what's generally overlooked, underloved, ignored, and has value and potential for re-rating upwards. And in 2021, commodities looked ripe for that.
Right.
And we think that the commodity supercycle, which we think we're in, really started in earnest in 2021. It starts in pockets. It started with energy at first in 21 and 22, and then it seeped into precious metals, which is what we're enjoying at this point. And there'll be other pockets as well. When it's in full-blown mode, everything will be running up because it will be tied to macroeconomic type of environment, and the dollar will be flat to down in that environment in our view, and that will support that. And it'll coincide with monetary policy as well. So this chart, just really quickly, is showing the history of secular cycles. So every time there's any kind of a major market cycle, it's usually dominated by some secular cycles. In the 1970s, it was oil and gold. In the 80s, it was Japan. In the 1990s, we all know the tech boom, which didn't end well. And in the 2000s was the last big commodity bull market, which was led by China and anything tied to Chinese consumption of commodities and the rest of the world and globalization. And that was when the last commodity bull market occurred. And since the great financial crisis, which is this parabolic blue line, is the tech boom, the NASDAQ 100, that's what that line is. And at the peak of every cycle, the narrative and the consensus is that this will never end. And this will go on forever, and it is infallible, and nothing can replace it. And history shows you, as you can see in the prior cycles, every cycle eventually ends. And we think that the current one is close to its peak. Who knows exactly when? Maybe we're close. We believe we're closer to the end of this cycle, given all the valuations and the inflationary pressures that might ultimately cause challenges from a valuation standpoint. So we think that that's where we are. So last thing I'll say is, when I usually get a question of like, what is this era like when you think about the past? You can talk about the dot-com boom and where tech is going. You can talk about the 2000s where commodities might be going. You can talk about the 70s. I believe we're living in a combination of the early 1970s and the late 1990s or the early 2000s. So it's really, I wrote a paper last year. It was titled "The 1972 Market is Partying Like It's 1999." And the way to think about it is tech valuations and equity valuations are very, very high. But at the same time, we're living in a potentially stagflationary world, potential a lot higher inflation. And that will ultimately cause rates to put pressure on the Magnificent Seven and re-rate commodities higher, along with the geopolitical and fiscal risk that we're seeing as well. So we run our strategies with a couple of sub-themes, and we implement it through equities.
So we have 1 or 2,000 before.
Yes, yeah.
Thank you, Eric. Were you around in the last quality super cycle?
I was.
I actually was.
I might not look that old, but I've been investing since the late 90s.
Right.
And so I was very much a portfolio manager, managing money in the 1990s .com boom. I was this young portfolio manager, and I thought tech was the best thing. It can do nothing wrong. Right. And I learned the hard lesson of the importance of value. And ever since then, I've been a value conscious investor. And so we lived through the 2000s of like a big boom as well.
Okay, yeah. Well, obviously I wasn't around in that, but I speak to a lot of different people in this space who are older than me. And one person said to me that, you're in the Supercycle when you wake up every morning and you know you're going to be a bit richer, right? You just don't know about how much.
Yeah.
Right? Yeah.
That's why it's early innings. It hasn't started yet.
Right.
May I pick up on one of your points in terms of the tech investments and boom? Because we're really in a similar situation right now. I mean, if you look at AI, the big question is it going to be a bubble at some point? I mean, there are a lot of people. Most people would ask in terms of professional investors whether AI at some point is in a situation where the bubble may burst. It's compared to .com. We all think that the picture's different this time because there's much more revenue generation, for most of these companies, and NVIDIA obviously is a unicorn. But the reason why I think it's quite important for the commodity market is because AI uses a lot of metals. If you look at, for example, data centers, AI data centers uses basically 3 to 5 times more of various metals than conventional data centers. So AI is a big driver also for server. And there is a second aspect to it. How are these AI data centers or data centers in general, how they're being powered energy-wise? And renewable energy is coming more and more into the picture. And guess what? Big part of the renewable energy is photovoltaic, where you need a lot of server. So, if this AI boom continues, and I think at least half of the investors do think it will continue, this is going to be a big driver for the server price.
I'd like to follow on to some of your points with AI and data centers and power consumption. Those are the same conclusions I'm coming to in terms of the power that they require and where it's coming from. And so what I've seen over the past sort of couple of years is that the big, some of the Magnificent Seven turned very quickly to nuclear, baseload power, and there was some unused capacity. I think it was Microsoft that went to, some of the 3 Mile Island capacity, which takes billions of dollars, and there's not that much unused nuclear capacity you can turn on pretty quickly. And so I had been saying that solar was going to be sort of the other place that the rest would go to, and I got some pushback on that because it's not considered baseload power. What we're seeing though is
without batteries, it's not.
Exactly. Yeah. That's exactly where I'm going, and that's what's the difference this time. And batteries require silver too, by the way. And so in 2025, we expect that we're going to have installed 60% battery capacity of 2023 solar panel installations. So batteries are really catching up very quickly. And if we look over the past year, the carbon neutral take-up of electricity, of power by the large tech companies was 5 times more solar than nuclear. And we know that solar takes 1/10 the time to build, to permit and build than nuclear takes. And so it's definitely become a solution for them. There's no question about it.
But Peter, even nuclear uses a lot of silver.
Yes, absolutely.
Yeah.
And the rise and so on, absolutely.
This is the most interesting thing when you about silver and the crisis is that we can have a real physical shortages in an elastic market.
Exactly.
So I think that makes silver more interesting than gold if you're going for returns.
Okay, yeah. Just quickly on this slide, I just want to get some comments on the bubble, the big question of the bubble, right? I remember in March someone put a slide up and it had circles of all the mining companies in the world, right? They were little circles, and there was a huge circle, and it was NVIDIA, and it encapsulated everything of the miners, right? And it is crazy. But I guess it can continue a bit more, can it? Or are we going to see liquidity coming out, going into the commodity sector?
I mean, the bubble can certainly continue for some time. We don't think it's going to perpetuate. Trees don't go to the sky, and just the law of large numbers, at some point the growth rate will slow down. Yesterday's market action was really, really telling. where Nvidia reported blowout numbers, and yet the market tanked and the stock was down because of other concerns that are liquidity driven. So there's a lot of liquidity that's driving it too. To your point about the size of these markets, those companies are behemoths. So when investors decide, and it's a matter of when, not if in our view, when the market decides that, you know what, I want to be in natural resources, like commodities, like gold, precious metals, silver, that big hoard of money is going to have a really tiny keyhole to get through into the small space. So, to Eric's point, the upside for these kind of names is going to be tremendous given the amount of money that could be flowing in there.
We kind of have to look at magnitude as well. I mean, if you look at the entire market cap of the mining industry, i.e. stocks, quoted stocks, what is that? It's the average of one Max 7 stock. This is what we're talking about, okay? So it doesn't need a lot of rotation from the Max 7 or the tech sector in general into commodities to make a meaningful difference. And I think we need to realize that the whole concept of rotation hasn't really played out yet. It did a little bit in the beginning of this year into European stocks, for example, out of US stocks, but it hasn't really started in a meaningful way. And I think when it happens, there's lots of potential for the commodity space as well.
Yeah, that's why
And
we
we
think
also see a rotation in from the bond side.
Yeah,
Precious metal.
exactly.
Yeah, it's not just from it.
Exactly.
So,
Yeah, that's a really good point, where, especially for the gold side, a lot of folks have been saying that, bonds really haven't delivered. They definitely didn't deliver in 2022, and there's another risk that they don't, especially the fiscal environment we're in. In fact, we might be in an era where sovereign bonds are a greater risk than corporate bonds, given the world we're in. And as a result of that, gold will be a safe haven. So I know this is a silver panel. So to us as outsiders coming in into this space for many years, gold, I'm a big Lord of the Rings fan, so we title gold as Return of the King. Okay. And so the gold has returned as the tier 1 sovereign asset, and that starts it. And then all of the other periphery metals and precious metals, they follow.
And is that what you're
So
saying
that's
then? Because you sent me a couple of slides. I just want to quickly get why you think this is the time. Is it because gold has started that move?
Yeah, gold leads the way, and then the others follow. And so silver is definitely a lot of catch up to do and trade, and it's going to do that, as is the PGM, like platinum, for example. And speaking of data centers and all of and one of our sub themes is build the future. That the rest of the world is going to continue to build its future, whether it's emerging markets, whether it's India, or even in the US with onshoring or attempted onshoring, even though most of it's going to Mexico. All of that will require copper as well, so that's a big part of our portfolio. But to your point, all of these metals will follow suit, and they're going to perform. And this is just the metals. And to Eric's point, the metals do fantastic, but the miners do even better, and that's why we're more exposed to that on the equity side.
and we are already seeing silver outperform.
Yeah.
Here in the charts, and we see the miners doing 2.5 points.
So,
Commodity side, we are already there.
what you're saying is that bonds are going from return-free risk to risk-free return to return-free risk.
That's right.
Exactly. And to Sven's point about the size of the miners or the industry versus the rest of the index, for example, silver miners are 5% of the gold miners. Publicly traded silver miners just represent 5% of all, so $950 billion of gold miners, $50 billion of silver miners, and that's after the run. So,
that is a very good point, Peter. But the complication for us as fund managers sometimes is as well that a lot of mining companies have silver revenue, but they are not considered to be silver stocks. So, we probably most of you know that 70% of silver production is a byproduct. So, for us to have silver exposure in a meaningful way and to talk to our investors about it, we have a limited universe of, let's say, 10, 20, 30 stocks we can invest into in terms of our restrictions, in terms of market cap, and ESG, there's other criteria. But we do also have to pay attention to holdings we have where silver is being produced and it will contribute to revenue. and there are mines which are either great or a risk factor for some mining companies, and they're not considered to be silver producers. So I think we have to be cognizant of that.
Good. You want to talk a little bit of the reasons as to why this is happening and why now. Sven, I want to ask you first just on the sort of the Fed side of it, if you like, the big bad Fed. What role do they play in this? Got your thoughts on what's going to come in the next sort of rate rise? I think it's December time, is it? Or rate decision time?
Yeah, I mean, I think the Fed is very important, obviously, for for the global economy and for global financial markets in general, and for various equity sectors. And I think, at the moment we are, we went from 90% certainty over December cut to 60%, and probably now we're closer to 50 or 40%, given the labor data which were published after the shutdown. And you could also have a more negative scenario where the cut isn't happening, or certainly not next year and continuing. And so if you remain at a sort of more elevated rate environment, that will slow down generally the economy to an extent, and obviously make credit more expensive also for mining companies. And also, what you've got to consider, particularly with regards to gold, but to some extent also with regards to silver, is, if you have high real rates, then the opportunity cost, is higher to go into precious metals.
Mm-hmm.
So that could be a negative factor for silver. I mean, I'm not necessarily, forecasting we're going to have rate hikes next year, but it may be a more of a neutral situation, so that we don't get the extra push from the Fed we may be hoping for. Mm-hmm. But I mean, I think even without that, there are enough positive factors we already talked about for the silver price to rise further.
Do you have a sense of the kind of economy we'll be in the future?
Yeah, I mean, I agree with us. We're probably going to have a stagflation type environment, certainly in the US. I mean, you never know with Trump in terms of his policies, how the tariffs really play out. So far, they haven't really been that inflationary, because the producers have taken most of the pain, and obviously there's rerouting, and it's a complex picture. But I don't think we can make really safe predictions right now what the U.S. economy is doing. But at the moment, they're still doing better than most of the other developed world.
But I would like to say that these things will happen, even if they don't lower rates now. I mean, they are data dependent, so they are not doing any decisions anyway. They could have concluded that. Yeah. But I mean, Trump will take over, and the rates will come down, if not now, then later and faster. And I think we're all going down to zero. Sweden is already at 2%, Switzerland 0%, and I think the US. And the big thing for precious metal is that we think they will start with QE next year, normally start QT. And they need to get the rates down.
I mean, if they
not the short ones. They need.
Yeah, if they lower rates politically, I mean, we have to keep in mind, the governor, the chairman, is only one person. He's not deciding on his own. But you're right. I mean, there are a number of governors who are up for replacement, as it were. And so if the Fed gets politicized, and the rates will be cut in any event. Well, to some extent it's politicized already, yeah, I agree. But if it gets more politicized and rates are cut, regardless, the economic picture, we're obviously going to have inflation, And so if we have more elevated inflation, and the US is happy to live with that, but not the growth, justifying it from a traditional economic cycle point of view, then that's a stagflation environment, which is good for precious metals.
Yeah, I would argue, so from the Fed standpoint, the Fed is a political animal, in our opinion. And this isn't the first time a president is badgering the Fed to lower rates. LBJ did it. He actually famously physically accosted the chairman of the Fed at that time in his office, and he said, "You're going to do something about rates." Richard Nixon did that as well. He appointed somebody to the Treasury Secretary to look at and be in meetings and involved. Mm-hmm. So pressuring the Fed to cut rates isn't new. But guess what? The last time that happened with those two presidents, we ended up with the 70s with stagflation. And so we think that this administration is trying to create a 1950s style, run it hot economy. They're okay with higher inflation, and because they're expecting a lot of growth. I think what they're going to end up getting is a 1970s stagflation. So they're going to try for the 70s, they're going to end up with try for the 50s, they're going to end up with the 70s. One last thing is that from a sequencing standpoint, we think that the economy is slowing. So the September job data was great, but the real job cuts occurred in October.
Yeah.
So I think we'll see that.
Yeah.
And so right now the market is like, will they or won't they? And there's this jitteriness in the market, and that's where you're seeing all of this liquidity receding and sell-off occurring. Once we get closer to December, they might actually cut, or they might not cut, they might cut, we don't know for sure. What we do know for sure, come springtime, this is going to be a different Fed. And this is going to be a Fed that will be accommodative. And whether we really need cuts or not, they're going to cut, and we will get the higher inflationary period. So I think bond rates would go up, whereas the short-term rates may be anchored. So we may get a repeat of 2022 all over again.
Well, we touched on energy a bit earlier. I just want to sort of swing back to that because I really like this slide that you sent me, where I said, look, energy is the universal currency.
Right.
Because I guess we're always going to need it, aren't we? It's never going to slow down, despite what everyone wants to say about environment.
Sure. Yeah.
We're always going to use more and more and more. So just, I wonder if you can just make a comment on your...
Yeah, so our sub-theme on energy is called Energy is Life.
Mhm.
Why? Because it is the essential ingredient. It is the foundation for not only our prosperity, but for our existence. So you can't eat your iPad, right? You can't heat your home with your iPad, but you need energy to heat your home, to convert any kind of activity to any kind of production. So from that standpoint, energy is essential. What has happened since the mid-teens is that in the US, the shale boom created this enormous amount of cheap energy for the world. Mm-hmm. And a lot of the shale players who created that energy, they went bust because they weren't good capital allocators, and they kept on digging holes in the ground to pull out oil. Now we're at a point where the energy space, especially oil, is probably the most hated, most overlooked, ignored, and underappreciated space in the market. It is extremely cheap, and those companies are actually generating good positive cash flow. If you look at it from a cash flow basis, they're actually better looking than the tech companies, because the tech companies are now capex heavy companies. So they're doing the exact same mistakes that the shale guys made in the 2010s. So from that standpoint, we think energy is really, really attractive. Okay. And most importantly, if we go into the era that we think we're going into, a la stagflation, one of the things that does the best in that environment is actually energy equity. Okay. So oil, just like in the 70s, it wasn't just gold, it was oil as well. Okay. And so currently the zeitgeist is that we have too much oversupply. That's the narrative, and that's the headline, and that's why oil keeps on being challenged. But despite that, we're not at $40 a barrel of oil. We could get close to that if we get into a recession, but that would be a generational buying opportunity. Why? Because this chart shows that while the current supply is there, the supply for the future is not being invested in. So for the future, we need that supply. And the other piece is, so the market is overestimating supply and underestimating demand. We think that the demand side will continue to grow. India consumes extremely low levels of oil on a per capita basis. If they're going to do anything that they're projecting to do, even a tiny bit of an increase of oil usage on a per capita basis will have many significant impacts around the world.
So you're bullish oil as well then?
Very much. So just quickly, 2 years ago, we had the biggest exposure to oil and energy. And last year, we switched it to the biggest exposure to precious metals. So right now, our biggest exposure is to gold and silver and miners. And energy is now second. Okay. And maybe in the second half of next year, we flip that. As we get past any kind of recession or an economic slowdown, I think on the other side of that, you're going to see oil probably do what gold has done this year.
Let's speak about energy. Which metal on this planet leads electricity and energy the best of all metals?
Silver.
Yeah. Well, I want to talk about that, Peter, because you sent me this, of course. This is a very nice looking chart. And yesterday at the panel, someone mentioned that India's building a solar
right.
farm bigger than Paris.
That was Ronnie, exactly.
yeah.
Exactly. A solar farm that is, I think, 5 times the size.
5 times the size of Paris. Wow.
And so what's interesting here, a couple of things to point out, is that the U.S. consumes or imports 43% of the silver that it consumes, and it's just deemed silver to be a critical metal. First time it's done that, and so that has all kinds of implications. Tariff potential implications, export restrictions. In fact, China just put on export restrictions on silver. They're going to be very, very particular about who they allow to export silver. Not that they necessarily export it that much, but it's a sign of how they view this. Wouldn't be surprised to see the U.S. administration do something similar. Some of the other implications are that it could help facilitate, and we've seen this in different ways, help facilitate silver production, streamline permitting, get involved in investing in some of these companies. We've seen them do it with even Canadian juniors, that have a strategic asset, copper, for example, lithium, for example. So for them to move on to silver wouldn't surprise me. So we can certainly see these kinds of things happen in the silver space since it's now been deemed critical.
But you speak about the solar panels, but what is interesting is not just it's growing, but the last 2 generations of solar panels actually use more silver.
Exactly.
I mean, at a time when they were using less and less silver, but now they want the efficiency, so they're using more silver.
The TopCon technology is very interesting because it increases efficiency, but it uses more silver.
To 50%.
Quite exciting.
Right.
And if you look at the growth rates, yes, a lot of that's in China, but it's certainly happening in the rest of the world as well.
Good, excellent. We've only got a few minutes left. I do just want to talk about how long you think this will go on for, because I think when we were having our chats just yesterday, I think you all pretty much unanimously thought we're not going to see a bust. I think that. So I want to understand why you think that. I don't know. Eric, I'm going to ask you first.
I mean, first we have to see a fair price gold. I mean, we like to see about compared with the debts and the Fed balance sheet, and then we think everything below 4,500 is rated cheaper than gold. And of course, when the gold would top, it must be much higher. I mean, it must be a mania. We got much higher prices, but actually we think if we keep going and they will print more and more money, because that's the only way what they can do.
Yeah.
And it's not really sure we're going to have this cycle, but something else will happen in 10 years or whatever, when we are at that stage. So I think it's a bit different this time.
I mean, for silver specifically, I think, you can have some volatility in terms of the economy, slowing down. If West stagflation is as you said, I think there could be a mild negative impact, but the secular trends of, solar and other industries, AI, they are much stronger to have a sustained slowdown in the silver market. And if you look at the deficits, we've had deficits for more than 5 years, and it's really surprising it took that long for the market to react, in terms of price development. And we're roughly at 200 million ounces right now, shortage, and we may go to a whole annual production now of around 600 or something million ounces. These deficits, they will remain because we know what the prospecting is of new mines. You can't turn it on; it's a byproduct of, as we know. So I think they will definitely supply or create a floor for the silver price. So for that reason alone, I don't think it will crash. The question is, how far can it rise? I think you have to have various stars aligning for that to happen.
Good. Let me go to you, because you sent me this slide, which I really like. Just quickly, your thoughts on.
Yeah, this is basically what I said earlier, that this is a 4-quadrant view of the world, especially the U.S. economy in terms of growth and inflation. And we think we're in the top half of this chart. Whether you're on the left or you're right, ultimately for commodities and precious metals, it doesn't matter. They still go up in both scenarios. But we think we're on the stagflationary side ultimately. Right now the market thinks that we're going back to Goldilocks. We don't think so. So just to summarize, the monetary policy and the fiscal situation of the U.S. is unsustainable, especially the deficits that the government is running. And when you look at history, when empires run into high levels of debt, there's only a couple of ways that they can deal with it. You can have austerity, and we don't do austerity in America. You can default. I don't think that that's in the cards. So that leaves the third option. You inflate your way out of the problem. So they're generally going to run inflation a little bit higher than nominal rates to keep real rates in a way where it will continue to, over time, erode the value of your debt. And that's what's going to happen over time. And so as a result of that, real assets will do better over financial assets, which is what that chart was showing earlier, the relative performance of commodities versus financial assets like stocks. So we think that that's going to do well. And then in that case, commodity companies, like mining companies, will do well. Specific to silver, I talked about gold, that's going to lead it. But specific to silver, I think, as we say in the US, it's got a double whammy. Why? Because you have the precious metals component and you have the industrial component, the real usage. So it's real need in the world for usage. And because of that double combination, I think it's just going to be better.
It's the only metal.
Yeah.
More that has.
Yeah. Both captures.
That's right.
Before I come to you, Peter, 30 seconds, just a quick technical cup and handle. We like to see that.
Yeah, on the left-hand side, it's about the structural deficit, and I think that's a powerful fundamental driver. But there's also a technical driver. We ourselves are not chart technical analysts, but we know that a lot of investors use various techniques, quant investing, algorithmic investing, or they just look at momentum. And so I think we can't ignore that. And from a pure technical perspective, the sort of cup and handle chart formation is a very powerful indicator of a further rise to come in the silver price.
Thank you. Peter, I'll let you finish with your thoughts. And if anyone has any tips for our audience, there were some great tips in March that if you paid attention to them, you would have done all right, actually. But no pressure, but if you'd like to.
And so, we talked about a lot of things that I think are very helpful in terms of how people should view silver. But probably for me, the best tip is it's volatile, but that you should not let that scare you. You should use that to your advantage. And so you'll get waves like we just had. I was honestly, even though I follow this area so closely, I had expected months back, almost a quarter or more, that it was getting too hot. It was getting too hot, and yet it kept going. And so, when you see these even if you see it a little bit afterwards, you see a peak and things start correcting. It's not necessarily a bad idea to start taking some profits. And you can roll those into cash, you can roll those into other names that perhaps you feel are less overvalued or more undervalued, depending how you look at it. And you can take advantage of the volatility that way. Just don't let that scare you. I think, and in the book I talk about how you have some of the largest market cap companies in the silver space have done 16x in a matter of years. Companies like Wheaton Precious Metals, Pan American Silver. One of them did it over 5 years, the other did it in like 2 or 3 years. So you don't have to be on the highest risk end of the spectrum in the silver space, and you can still get these kinds of returns. Be patient and wait it out, and it'll play itself out.
Okay, good. Very quickly, because I know I'm going to go to Barton Gold. Anyone else have any tips? If you want to mention some stock names, I'm sure that'll be very welcome.
Well, anybody who doesn't want to invest in our funds, we are very transparent, so we have all the holdings on our webpage.
Okay.
You can just go in there and copy. But I do think that a portfolio, the silver is very volatile, equity itself is volatile, silver equity, it's really volatile. We have reported 2% and a nice volatility. So I think you need to take away some company risk and have a portfolio of 20 subject holdings. I think that's very important.
Yeah, we agree with that.
And 10 of our holdings are here. That is right.
So there we go. Okay. Well, thank you, everyone. Thank you very much for that. It was a great panel. I need to go to Alexander Scanlon from Barton Gold. Pretty short a little bit, but thank you for your time. Thank you. So,
Space guidance is more than just a few more thank you so much. The rest of us, so cold, so, and we're just